It's great to see so many of you here today, and I think it's a reflection of the attention we're all placing on trying to develop a workable understanding of the economic and geopolitical climate that seems to just keep giving in terms of challenge and conflict to be understood and navigated at the moment. We're all aware there's some major elections next year, and we each may have a view on how that could impact not only our own economy and social governance, but the other economic and political systems that impact us, our families and organisations. I'm delighted today to welcome Yael Selfin as our guest economist, and I'm confident that we're all going to leave this session with a clear understanding of what lies ahead and both the risks and opportunities for our companies. Yael is the Chief Economist at KPMG and a Fellow at the National Institute of Economic and Social Research. She came to my attention with her writing on navigating uncertainty, but also because as well as being an expert communicator, she does actually advise clients on the global economic outlook and its impact on their operations. Through recommendation, I've been told that Yael and her team offer insight and analysis of relevance to current business strategy, and I think as a result bring a practical and user-friendly interpretation to the various elements that we gather into the term economics. Today, rules of engagement. After Yael has made her presentation, there will be an opportunity for Q&A. So please do put your digital hand up to ask a question, or you can ask a question via the chat, and I'll be keeping an eye on that as well. Yael's very keen that the session is interactive, so please don't hold back with questions, and we invite, as always, debate and discussion amongst the group. So for now, I shall pass over to Yael. Thank you.
Thank you, Karen, and good afternoon, everyone. So I am going to start by trying to share my slides. And essentially, I've been asked to particularly cover three areas, actually four areas, but I'm going to start with three first and then talk about the fourth, which is really all about uncertainty and how can we actually be confident that whatever we are seeing is in the right direction, because as you know, as with many other sciences, predictions may not necessarily happen, and there's loads of other things happening at the same time. So we just really do need to put this into context. So today I'm just going to look a little bit about the global economic outlook, focusing on the UK, but also on other economies that are important for us. And then I'm going to touch a little bit on research that we've done on generative AI and how that could impact the labour market, particularly in the UK, but not just in the UK. And then focus a little bit on the fiscal outlook and on what government could potentially can or cannot do with the room they have to spend. So that is quite a lot to cover. I've got quite a lot of slides and I'm going to go through them relatively quickly, but then hopefully I'm going to try and leave a lot of time for us to then discuss things, and hopefully I can answer things for you, questions that are a little bit more specific to your own companies and things that you're grappling with at this stage. So let's start with the global outlook. And before we look forward, I just wanted to really mention here, one of the things that is really good to bear in mind is that we're just almost, it hasn't been very long ago where we were going through the COVID pandemic and where we experienced relatively sharp contractions in output across most economies. And the recovery from that was particularly strong. So for most economies, the size of the economy is now back or larger than what it was prior to the pandemic, which is good. It showed that we had managed to rebound quite quickly at a cost, definitely at a cost, and part of it is the public finances that I'll speak about towards the end, but that was definitely a very good starting point when we look at where we are at this stage. And then subsequent to the COVID pandemic, we had an additional shock for the economy. We had the invasion of Ukraine. And as a result of that, as you can see here, we had a surge in energy prices, gas prices, particularly an issue for the European market. But at least when it comes to energy prices, we have now seen very much a reversal of that spike in energy costs, although since the summer we've started seeing a rise in energy prices, and obviously the conflicts that we currently are experiencing in the Middle East may or may not, but may have some impact on energy prices going forward as we're heading towards the winter. But also there's still also some uncertainty as to where Russia is going to be on their energy strategy. So there's still quite a lot of vulnerability when it comes, and uncertainty as well when it comes to future energy prices for us over the short term. And what it means is when you look at inflation, we had inflation going up significantly as the economies were opening up. That was a combination of very strong demand and problems with supply chain, etc. And then on top of that, we had the higher energy prices. So all that led to very high inflation. Here you can see the, if you like, the average inflation across the G20 economies with a band of the performance across different countries, but generally the direction has been very similar. But the direction for the last few months already has also been very similar in terms of the downward trend. So it is safe to say that we have reached the peak already of inflation, and now we're gradually seeing inflation going back to target. Different countries are experiencing different pace of that. In the UK, we're a little bit of a laggard. We've got a slightly stickier inflation here, but it is definitely going downwards. A lot of it was driven by that headline fall in energy prices, so that there's just one person that is not muted at the moment. Yeah, and he is now, or she is now, which is great. Thank you. So it means that you are listening, which is very good. So we may see a little bit of additional upward pressure on inflation, because a lot of it is driven by, in terms of headline inflation, by things like energy costs. But the momentum generally is definitely on the downside, which is really great news, because that has been a big burden on households and companies. When it comes to interest rates policy, central banks are responding primarily to that change in inflation. As you can see here, the majority of central banks were cutting rates during the pandemic in here, and then they started raising rates once the economy opened and inflation started to accelerate. We have probably reached the peak, or are reaching the peak of that cycle of interest rates hikes at this stage, and we've already started seeing some central banks cutting rates, especially around Latin America. There's a few that have already started cutting rates, and it is safe to say that we would expect rates across the major central banks to remain more or less at the current level for a little while. So taking the UK as an example, we've probably seen rates peak at the current level, but we're not expecting interest rates to start fall again, but for probably around a year. So we could see that relatively high level of interest rates staying for some time. And that has a major implication for households and businesses, because as you can see on this chart, and as you can very well appreciate, and actually the time horizon is probably much longer than what we have here. We had very, very low levels of interest rates for a very long time. And then we've had a very sharp increase in interest rates over a very short period of time. And that has been another, if you like, shock for a lot of businesses and households. So not only that they had to deal with the fact that their purchase, if you look at household, they had to deal with the fact that their purchasing power was eroded because inflation was very high compared to the wage increases, so they had less spending power, but also the cost of credit increased, so their mortgage cost was gradually rising. Looking at the implication for asset prices, because higher interest rates will probably, one of the first things where you would see it is asset prices. It is really the commercial housing, commercial prices that we're particularly worried about. We have seen some correction in residential house prices across different markets, but that probably came in a large degree from relatively high valuation. So in some way that was expected to some level. But when it comes to commercial property, there's other currents there as well, where we see potential influence from what we call structural changes. So for example, when you look at retail, we have pressure from the move to online that makes physical presence potentially less profitable. So the value of retail property may be affected by that as well. When you look at office space, again, as well, hybrid working means that potentially you need less footprint in terms of the office space. So that puts additional pressure on the price of offices on top of the fact that interest rates are higher. So that is a market that we are particularly more worried about, if you like. And you can see that also in terms of the investment trust valuations across sectors where the values have gone down. On the residential side, one of the other reasons why we're less worried about it is because generally when you look at the labor market, it is relatively strong, or if you like, relatively tight, depending on how you look at it. So if you look at starting again from COVID, the COVID pandemic, we saw unemployment rise quite significantly in markets where it was the jobs were slightly less protected. The help to household was not in the form of what we had here, for example, in the UK as furlough schemes. We did have an increase in unemployment, and that has now been reversed, with the labor market generally across quite a few economies even tighter than where it was prior to the pandemic. And that means that for most people who want to have a job, they can access that. They can have a job. There's job security is quite strong. And that means that one of the significant triggers of a significant correction in house prices, when you have very high unemployment and you have the fire sales of assets, that is less likely to be at this stage, which is why we're less worried about the residential housing market, especially in countries where the labor market is very tight. Looking at growth at wages, which is what's very close to your heart, we have seen, as I mentioned earlier, we have seen a squeeze on purchasing power. We have seen pay growth to be, on average, lower than inflation across many economies. So when you look at 2022, for example, real pay growth, which is the pay growth when you take account the inflation, was negative throughout, with some economies more than others. Whereas for 2023, the expectation is that at least for some economies, you would already see a little bit of an improvement. And for 2024, we will probably see positive pay growth across the board, because we would expect pay growth to overtake inflation across all economies, given that inflation is falling quite rapidly across the board. So that is good news. It means that consumers will have more purchasing power and will gradually be able to recover their purchasing power over time. When we look at confidence, consumer confidence across different economies, that has picked up potentially on the back of better improvement in purchasing power. But households generally are under pressure. So a lot of households, especially those that are middle income and above, have managed to save additional saving during COVID, because there were quite a few things they couldn't do. They couldn't travel, they couldn't go out. So they had what we call excess saving that they can then use during this time where they had pressure on their income, on their real income. But as you can see here, across many economies, that is now almost depleted. So they've run out of that ability to smooth their consumption. And while inflation is going down and their purchasing power is going to be potentially restored gradually, what they will have to increasingly deal with more is rising mortgage costs, because mortgages, for most people, they tend to be fixed for 2 to 5 year duration, and that means that they will gradually move on to higher interest rates, and that is something that they will still need to deal with. So generally, I'd say households are still squeezed. They're not feeling, they wouldn't feel particularly chirpy given where we expect them to be over the next year or two. They're still going to be under pressure. So when you think about reward, when you think about where your employees are, that they will feel under pressure, continue feeling under pressure, at least to some degree. So moving on a little bit to other parts of the economy, when we look at corporate sentiments, business sentiments, it has been a little bit mixed, but not particularly strong. Overall, certain issues like supply chain seems to have resolved. We had a lot of problem with supply chain as the economy was opening up. That is no longer the case. We've also, the issues we had with very high shipping costs is no longer the case, which gives businesses a little bit more margin when they have to deal with higher interest costs. But overall, there's still quite a lot of headwinds. When you look at trade, for example, the volume of trade is still very weak. That is partially because the number of restrictions of trade have increased quite a lot, partly due to the fact that we have increased geopolitical tension between West, East, and others. There's increasingly more divergence, I'd say, in the way we tend to interact globally on the economic side, and that is being reflected by weaker trade growth volumes. So overall, what it means is that the short-term outlook is relatively mixed across different economies, but not strong overall. I'd say there are very few countries where you would expect, based on the PMI indices, to see any significant growth. Anything above 50 shows growth. So there's some hope on the horizon, especially actually US is one of the economies where the outlook has become a little bit more stronger recently because of the relatively strong performance despite the headwinds that they had and the sharp tightening in terms of the monetary policy there. So that will keep the economy, the global economy going. But when you look at overall forecasts for different countries, you'll see it's relatively weak for this year and next year, with inflation moderating and back to target in 2024 in most economies, while unemployment staying relatively low in historical context in these different economies. So that's the outlook for, where we see things over the next couple of years. Relatively weak, but no recession across most economies. The big question when we look a little bit ahead of that is where will growth come from and how strong it could be. And that's where we tend to look at productivity, because productivity is really the key driver of growth for economies. And as you can see here, I've got a very long time frame for you here. It tends to fluctuate quite a lot. So there was a point around the 70s and the 80s where we had relatively strong productivity. But then since the Great Recession of 2007, 2008, we've seen productivity in the UK in particular, but not just in the UK, falling. Productivity growth has fallen significantly. And without that, it's very difficult to see overall economic growth rising much more than, say, 1%. Yeah, so previously we would used to say 2.5% as real growth for the UK economy as a norm. Now we're moving to more 1%, which is much weaker. So there's hope that things like AI and technology will boost productivity. This is really what we're hoping for. We've looked at generative AI in particular to see where it could help the labor force, and we found that there's certain tasks that are likely to be potentially more prone to change or to be automated using generative AI. Overall, that would mean that there's certain professions that you can see here that are likely to see a bigger proportion of their task, if you like, automated. I'd say generally it's very unlikely that you would be able to replace a whole person by this technology, but what you would be able is to replace some of the tasks, and then you will need to create new tasks for them or for others to use in order to deploy that technology. So I wouldn't say that it's necessarily going to replace people, but potentially shift people to do other tasks with potentially a little bit of saving in terms of labor input overall. So generally, what we find is that there's a little bit of a worry that with generative AI and all these technologies, the need for people will disappear. And some people are just, think of like examples of technologies that we had previously. So when you think about engine, the introduction of the engine in the US, this is just an example for you. You see previously how many horses were used, and gradually the reduction in the number of horses over time that were used and how they were replaced by machine. So one of the things to bear in mind from this example is, number one, it takes quite a lot of time for new technology to be embedded. Increasingly, it takes shorter time, so I don't think it's going to take us necessarily 60 years to embed AI, but it is fair to say that we're still at the experimental phase where we have the new the first adopter trying to see where we can use that technology, and gradually it will be embedded in work. So that's the first thing to think about. And then the other thing to think about is that as you have the new technologies, and what we don't have in this chart, as then you have all the new jobs that were created on the back of it. So there have been a few estimates of how much we could expect AI to improve productivity. And as you can see here, there's a very large range of how impactful it would be. I'd say our estimates are very conservative among all the others, but we're looking at the first impact only. So essentially, by introducing AI, how much would you save on labor cost, essentially, more or less? That's really what we're trying to measure here over 10 years. And that is a direct impact. The indirect impact, which is really the very interesting and exciting bit, is on the back of introducing AI in the immediate task, then how much can you improve other things? So for example, if you introduce AI in research, then that could accelerate the implementation of new technologies in other areas that were dependent on that research. So the secondary impact of AI is really where we think there'll be a lot more benefits, but that will take time to unravel. So it's very difficult to predict at this stage. But all of it is positive. I just think we just need a little bit of patience and encourage as many organizations as possible to experiment with how this is going to influence the workforce. Here in KPMG, we're running a number of case studies of how we could use generative AI in particular in the way we work. And I know there's other companies trying to do that, and it's really helpful to look at these case studies and learn from them how you could best embed these new technologies. So that is, I think, good news for us in terms of the hope that we will see growth stronger than this bit of a weak patch that we've been experiencing for a while, but we will probably need to be a little bit patient. So let me just look at the last topic that I wanted to cover with you today, and that is government debt and public finances more generally, because that is really important as one of the catalysts for growth as well, because we will need governments to invest as well in order for us to grow faster. We can't have it all we can't rely completely on the private sector in this sense. And I'm thinking investing in the broader sense, so it's not just in technology, but it's also in education, broader infrastructure, etc. So looking at this chart here, it's a little bit busy, but hopefully it's quite self-explanatory in the sense that, as you can see, we started prior to the great financial crisis in 2008, 2007, we started with debt levels that were relatively okay. So in Europe, many years ago, the Maastricht Treaty said European EU countries or Eurozone countries needed to have debt levels that were below 60% of GDP. Since then, there's been a number of studies that showed that there's a cutoff where anything maybe around above 100 or so is really detrimental for growth, because it acts as a burden more than actually something that will help us grow in the medium longer term. So as you can see here, we had the great financial crisis, and as a result of government's assistance to especially the banking sector, but not just the banking sector, we had debt levels in the black square rising quite significantly across a lot of countries, especially countries like Ireland and Greece and Spain. I can see Spain and Spain. But then after that, we had a period of relatively weak growth, partially because we had weaker productivity, and therefore governments didn't manage to really reduce the debt that much across quite a lot of the economies, because they had less revenue coming and they had to spend more on benefits, etc. So that meant that just before the pandemic, some economies had even higher debt. They managed to accumulate even more debt during that period. They also had relatively low interest rates, so they were a little bit complacent as to the level of debt because it didn't cost as much. And then subsequent to the pandemic, we've seen debt levels rising even further in some of these countries because governments were spending even more on trying to protect the economies during the COVID period, and then also trying to protect households and businesses from this shock in terms of higher energy prices. So we've seen even recently relatively large proportion of spending by a lot of governments, which really got us where we are. We are at a point where the level of debt across many economies is very high as a share of GDP. And the trouble is that when you look ahead, the potential drain on public finances could be very significant when you look at the demographic, and just if you project the potential rise in pension costs and healthcare costs and long-term care, that could mean another big burden on public finances, which would make them even less sustainable as a result. And when we look at the revenue side, well, can government try and recover a little bit more revenue from the economy? As you can see here, the proportion of taxes that is already levied on income, on people's income, which is really where most of the taxes are, is relatively high. So the tax burden is relatively high, and as you in particular will appreciate, people are much more mobile at the moment. So the scope of increasing the burden on labor, in the taxation burden, is really limited. And more generally, when you look at the tax burden, so the tax revenue as a share of GDP, it is relatively high. So there's probably not that much room for government to increase taxes, whereas their spending bill is likely to increase quite a lot. They're also at this point in time where interest rates are very high, and not only that interest rates are very high, given that they have shift in terms of the debt mixture to a larger proportion of what we call index-linked debt. So it's debt that is linked to also the rise in inflation. Their debt cost, their spending on servicing the debt is rising, especially in countries like the UK, where we have this double whammy of higher interest rates and also higher inflation. So that makes overall public finances much less sustainable in the medium term. And there'll be some really important questions that will need to be asked as to how can we continue growing, continue investing. And there's a number of things that governments will want to invest on, like net zero. They'll probably start spending a little bit more on defense, given the conflict between Russia and Ukraine, at least in Europe. So there's a big question of how can you manage this equation where ultimately, as we go at the moment, it's not really very sustainable. One of the ways of trying to tackle it, at least to some degree, is looking at retirement age. And as you can see, it's a bit complicated chart, but what we're trying to convey here is what it would mean if retirement age moved along with life expectancy. How much would you be able to, what it would mean for public finances? So if you look at countries like France, for example, they're currently, if their plan doesn't change, that would mean that just in terms of pensions, the cost will rise by more than 2% of GDP. Whereas if they start increasing retirement age by, according to life expectancy, they will see a reduction in pension that will be equivalent to more than 2.5% of their GDP. So that's a big change, actually, but it's not the whole solution. It would need to come as a package. What it means for you in terms of reward is private pension will probably be much more important for people, especially if they want to have more flexible retirement age, because it is likely to be, pension generally is likely to be something that government will need to look at. So let me stop here because I've spoken for an awful lot of time, and open the floor to questions.
Ben, you have the first question.
Thank you, Yael. Really interesting. I just have a question. You mentioned the Ukraine conflict, and I just wondered what if there's any thoughts on the economic impact of the conflict now in Israel and Gaza. If there's any early thinking on what you think the consequences of that might be.
Sure. So, I mean, these are really early days, so it's very difficult to tell, and hopefully things don't escalate that much more. I think the main thing globally would be energy prices. At the moment, they shouldn't be affected, but they may be affected to some degree, especially oil prices, not so much gas. And then it's an increase in uncertainty, so that always tend to affect business investment generally, potential, pressure on supply chain, a little bit trade. So it's business investment, trade, supply chain where you would see potentially more of a link if the tension extend further. And the geopolitical uncertainty extends further.
Thank you.
Yeah, I've got a question relating to economic research on climate change, actually. So would you be able to give a perspective on what you sense is the accuracy of current economic research as regards climate change, and specifically the current accusation that pension fund managers should probably be paying more attention to climate scientists than they are economists?
So I am not a climate change specialist. All I can tell you, because actually it's quite timely, because I advise the OBR and part of it is on the climate change projections. So is that things are very uncertain, because we're very uncertain about technology, the technology in terms of mitigation, and technology, across the board in terms of energy generation, etc. Things are moving so fast that all we could do is just have some very high level assumption, which I think are very helpful because we need some direction. But we just need to make sure we all understand this is within the really very large ballpark of high level assumptions with technologies that keeps changing all the time.
Thank you. Quentin?
Yeah, my question was about what's going on in the bond markets. I don't pretend to understand the bond markets, but I'm led to believe it's important what happens. And I see that in the last few months, even after the budget last year in the UK, that longer term bonds interest rates, the implied interest rate has gone up to new highs, even 20 years out. Is that explained by the chart that you were showing on the pressure on government finances?
So, yeah, so it would be partially that. And it's also the fact that you have relatively limited supply and a lot of pension funds that need to buy. So it's kind of the supply and demand, I think, a lot in the UK. And then you have the quantitative tightening that potentially is also implicated, and the expectation for that, even though the Bank of England is trying not to make it an active policy tool, it is probably in the margin making an impact as well. And then you have the complication of flight to safety, and whenever you have a little bit more extra geopolitical uncertainty around. So I think there's a lot of factors there, and it's hard to tell exactly what's what. There's a premium on the UK in particular that tends to change as well, and has changed.
So that makes the UK government's position even more precarious in terms of public finances, does it? Or more difficult?
Well,
or does it have no impact? Does it make it harder for them to get bonds away, and therefore they have to pay more interest?
Yeah, I mean, if you have higher yield, you have to pay more when you issue the debt. Obviously, it's more costly. Yeah.
But the same dynamic's going on in the US as well, isn't it?
Yeah.
With bonds, which is more worrying for the global markets.
Yeah, to some degree. So it's not just a UK only phenomenon, and it is still unclear why it is happening. So there's a number of potential hypotheses. There's potentially risk aversion, but it is definitely something that people are talking about and trying to understand what's going on. And I don't have the answer. I haven't seen it either yet.
You haven't seen anybody else publish it either. Thank you.
Well, there's a few potential hypotheses that are related to first of all the people in the market. So it depends on the supply and the demand and where the investors want to go. And then it's the quantitative tightening, the expectation of quantitative tightening, and it will have less impact or more impact in different countries depending on where you are. And then there's the expectation for public spending and how much more debt each government is likely to issue based on their plans, their spending plans. And then you have the flight to safety and investors just wanting to buy that stock in particular or not, depending on what's happening elsewhere.
Thank you.
Yeah, we've had a question relating not only to sort of AI, but broader technology development. And the question is that, do you think the growth impact of any development in technology is likely to offset the increase in government or social spending due to demographics? And in a nutshell, do you think AI will fund our retirements?
If only. Let's hope. Yeah, you need to retire a bit later than me, maybe, for that. Although I'm not retiring yet. Yeah, so I'm relatively very optimistic about technology, because I think there's a lot, not just within AI, but also in data. There's a lot with data that we can do better. And if I look at a lot of the companies that I speak to, there's really a range of how well they've embedded big data and the latest technology. And I think there's a lot of scope for companies to become more efficient, definitely. And not just companies, there's even to some degree a lot of scope for government, for public sector to become more efficient. And that is a big chunk of our economy. So I think there is definitely a big opportunity there. I think it will take time. And but hopefully we will see stronger growth as a result of it, which will make it easier for us to save our asset will be worth more. As a result of it, we'll be able to earn more, etc. So hopefully we will have slightly better retirement as a result of it. But it is a process. It's definitely not something that's going to happen overnight. And it's not universal. So there's pockets of the economies that need more attention and need to progress more than others. And I'd say what we can do as businesses and people who work in relatively large organizations is try and help the rest of the economy come on that journey with us.
Does anybody else have a question? Phil?
It's very much, it's very much along the same lines. I'm reading articles in the FT that say that a lot of the technological improvement has come in consumer and retail. And whilst my children and my wife are very grateful for that, I'm just wondering when the improvements in technology will actually hit the broader business environment, manufacturing, transportation, logistics, healthcare, which I read account for 75% of global GDP. And so it seems that so far that the improvements in technology have hit the sectors that probably are least, well, they may be important to some people, but perhaps less important to business.
Yeah, it's a very, very interesting observation. Yeah. So we also, I think that opens up the question to a slightly broader topic, which is what's important. So in terms of welfare and consumer welfare, and what do we value more generally in terms of our quality of life. So you could say certain things have improved our quality of life potentially, or our of consumer surplus, if you like, but not necessarily productivity in terms of producing better. But I think we've also seen, I mean, just looking at what we're doing now, that is potentially more productive in the sense that just after this, I'm doing another presentation straight away, which I could not have done before because I would have had to travel there. And I would not have been able to squeeze that in. So we are doing more as well within business, definitely, but it's not enough. We need to become more productive.
It doesn't, so the technology doesn't seem to be showing up in the productivity statistics.
And partially it is possible because it takes time. It took time before. When we look at, for example, the introduction of the web and online and all that, it took a while for it to be embedded in kind of day-to-day practices and the way we actually worked. You know, it took time for us to move from working papers to actually everyone to have a laptop and then starting using the internet, whereas the technology was already there. So I think that this is, you know, that's one of the messages really, is that it does take time and we will need to try and accelerate it as much as we can.
Thank you. Thank you much.
Thanks, Karen. Yeah, thank you for the presentation. I also found your comments about the productivity concern, it's about to be 1% for the foreseeable future, to be particularly depressing. I'm interested to know what you think government should be doing to help increase that specifically. However, I had another question, which was brought out, I think, in my mind when you showed the range of impact AI will have on jobs, particularly wide range. And of course, your predictions is very low, as you pointed out yourself. And it took my mind back to the sort of weather forecasters of the 1970s and 80s, where weather forecasts really were pretty crap. You know, they weren't very reliable, they weren't very good. And over the years, maybe probably through technology, they seem to have got much better in predictions. And economists over the last, I would say, 5 to 10 years, seem to have got everything wrong. I mean, all their predictions and doom and gloom seems to be awful. And the credibility of the profession of economists seems to be therefore under real pressure. And I'm curious to know as to what you think the economists should do to improve their forecasting, and whether you think it's a crisis within the economist world, or in fact, do they not care about it and they just keep looking at lovely charts?
Very good question. So, unfortunately, we are not like weather forecasts, and I don't think we have the tools to improve the way you can improve the weather forecast, because ultimately what we're trying to do as economists, we're trying to predict people's behavior, but millions and billions of people's behavior. Yeah. And
so does that mean ultimately that AI will take over economists?
Well, we've done some tests on that and they're not very good. So maybe not.
Very good solution.
So, I think what we need to do as economists is always be very humble and say, look, we can try and help you see things. Yeah. So we can try, just like as I was saying to you earlier on, based on everything we know now, based on everything that we know now, and based on how we know things reacted in the past, this is what we think will happen. But things change, people's behavior change. So now, for example, we don't go to the office all the time necessarily, or we don't necessarily want to go to the shop every day. We want to do certain things online, or we get our information differently, so we respond differently. So things change all the time, and we need to try and adapt to that. But very often, the only way in which you could be certain how it will change is by observing it. So it's not easy to be an economist. And all we can do is give you our best guess, if you like, an informed guess. Yeah, that's the way you should see us. I think we're better placed to tell you what GDP and inflation will be next year than someone else, because we follow certain things, and the certain things that we know happened and we know are likely to happen as a result. It's quite logical that this will be the next step. But if there's another shock and something else happens, then we'll be wrong, obviously. So, for example, if I look at one of the very typical criticism of the Bank of England, for example, where people were saying, well, they should have increased interest rates much earlier, they should have seen inflation shooting up. To some degree, they're right, but then a big boost to inflation that we had last year was the invasion of Ukraine. And not many people predicted that. It wasn't in the forecast. So you need to see economic forecast as based on everything we know now and based on previous behaviors, this is what the likely outcome is.
Okay, thank you. And comments about productivity, what governments can do?
Productivity in government. So I think the first thing they need to do is be more clearer and look at the longer term, because in order to improve productivity, a big chunk of it is to increase business investment. And business investment is something where you need clarity and longer term clarity and certainty. So being able to provide that more stable environment is really important, and it's very difficult to do when you have a political cycle of only 5 years and a change in policies and change in prime ministers that is quite frequent. That is very difficult for business. So I think that's number one. And then there's the basics. The basics of education is very important, and flexible education and upskilling the labor force more broadly. Supporting people who want to work, not just with education, but with other things, trying to bring in the chunk of the society that is not in the labor market, trying to bring them in. And that's not just for productivity, it's also just for improving the wellness of the society as a whole. And then it's a targeted investment that you need in certain areas where that would drive growth. So there's certain things, for example, when it comes to electric vehicles, when you need the grid to be strong enough to be able to actually absorb all of that. So those are the things that the government needs to put in. And energy policy, a robust energy policies is one of the things that they need to invest in, as an example.
Great, thank you very much.
So I'm conscious of the time. Yael, thank you very much for everything you shared with us today. Following on from Martin's comment, given most of the forecasts we see are quite depressing and downbeat at the moment, I do hope they will prove to be wrong and we end up in a much more optimistic place. But given the core of the content you've shared, I don't think that's very likely. But huge thank you for your time today. Greatly appreciate it, and the effort that your team has put into this as well. Thanks for joining today. Our next in-person event is on the 8th of November, where we'll be taking a look at the management of corporate risk and how that's changing in the turbulent times in which we now live and will continue to live. But for today, thanks very much, and we'll look forward to seeing you all again soon. Thank you.